Note that this episode was recorded prior to the September 18th Fed meeting, and therefore references it in the future tense.
Nothing brings about more anxiety than change, especially when it's possible changes to the federal tax code. With the Tax Cuts and Jobs Act set to expire next year, your tax bill could get an overhaul and potentially impact your portfolio and financial decision making. But don't worry, there is still time to make a plan. Foster and Motley's Luke Hale and Megan Lyons join me, Patrice Sikora, to talk about the possible upcoming changes in tax law and their impact on everyday investors like you. So, Luke and Megan, great to have you here.
Thank you, Patrice.
Thanks for having us.
Luke, let's start with a review of the Tax Cuts and Jobs Act, how it came about. What should we know about the origins of this bill, and what are its most important takeaways?
It's really interesting in a way and complex in many other ways. But the interesting way is the way it got passed. So it was passed in 2017 under former President Trump. And the only way that they could make these changes, because they didn't have enough congressional members to really make it permanent, was to vote it through for a period of time. So they made it's the TCJA, we'll call it by an acronym as quickly as we can because it's such a long title. And anyway, it changed a lot of things in the tax code, and we'll go into those kind of things. But the sunsetting, so that's a word that we need to talk about. A sunset is when something goes away naturally. And that's what's going to happen with this. And to my knowledge, there's not been many things of this magnitude that have sunset that affect us all. And sunsetting means at the end of 2025, this just magically goes away and we go back to where we were in 2017, assuming people don't make decisions to extend it or revise it.
So, what does that mean going back to 2017?
Well, it means taxes were a lot more complicated in 2017. And before this happened, people were using itemizations a lot on their tax return. So you had to save your receipts for medical stuff and a lot of charitable things. You know, you take a box of stuff to Goodwill and you get the $100 receipt. These days, the standard deduction is so high that most people don't itemize anymore. So because you don't itemize, you don't have to save all those little receipts. But the tax code, if anything, it is complicated and it differs from person to person. So as Megan and I were thinking about how we wanted to approach this very complicated topic, I would say at the outset, this is a call for awareness. You need to know that something big is going to happen, but we don't know what it is. It's a definite maybe. So it could continue on as is the tax code right now, and no changes will happen. It could sunset, and all the 2017 provisions would come back, and it'd be like the time from 2017 to 2025 never happened. Or it could be somewhere in between. So it's a call for awareness and probably a call to your financial advisor to figure out how this could affect you, because everybody's income tax is so personalized.
Megan, tell us more.
Yeah, there's a lot of specifics we could jump into here. If we think through what is most impactful to most people, the biggest one, Luke already mentioned, so the itemized standard deduction is currently, as of this year, at $29,200. So for a lot of people, that is a great little chunk of money to pull off of your taxable income. And you are by no means going to exceed that if you were to itemize your own specific deductions. So that's an automatic, I would say, a very impactful place where most people are going to see a bump in their tax bill because all of a sudden they will have to count more of their income as taxable income. Some of the other important things were it limited this bill, the TCJA limited the deduction of mortgage interest. So actually it would actually be moderately beneficial to some people if we reverted, because they'd be able to deduct more of their mortgage interest. It did a couple things around 529s where it allowed 529s to be used for private school, I should say private school tuition that is not at the university level, so anything below it could be used. Up to $10,000 of a 529 could be used on private elementary, middle, and high school educations. So that was a nice benefit that will be going away if we revert. And then the child tax credit actually was bumped. It was up at 2K. If it reverts, it goes back to $1,000 per child. So there's a variety of ways this is going to impact people. Those are some of the biggest ones that affect like the largest swath of people. If you're in different tax brackets, you're going to feel this differently. Perhaps the hardest to visualize, but honestly the most impactful to the almighty dollar is going to be that tax rates are changing. So what TCJA did was expanded the ranges of the ordinary income tax rates so that more people were taxed at a lower income level. That's going to revert, and most people are going to, on the overall, pay more dollars in taxes should this sunset. It's important to note that TCJA impacts both individuals and businesses. The things we're discussing today are primarily oriented entirely to the individual because that is the portion of the tax bill that is set to sunset. Most of the changes that affected businesses are likely to continue as is because there was more agreement on those pieces. So a lot of things to tackle, a lot of things to look into, and hopefully we can lay out a couple examples so people can really get their hands around in an example what it might look like for somebody this year versus in 2026 when these changes might sunset.
These changes all sound very, mostly, I should say, beneficial for the individual. So, how would it be that our Congress wouldn't stand up and say, oh, let's continue these?
I think we,
That's a great
yeah,
question.
our Congress doesn't get along very well. And that's a
Yes.
problem. That's a problem in a lot of ways. And sometimes actually from a financial perspective, it's good that people don't get along because a lot of times you end up with gridlock. Financial markets love stability and gridlock will equal stability, except in this case, because gridlock actually will mean the reversion to the sunset provision. So my observation and maybe others is that they don't get along very well and they don't get a whole lot done together. And they're going to have to do some things together, potentially to make this not come back to 2017 levels.
Certainly sounds like a kumbaya moment could be coming for me. I'll tell you. Let's get this together, people.
And it's important to note that, as Luke said, this is a definite maybe. We don't know and we won't know. We may not know until we are in the middle of the 2026 tax year, which feels wild, but there is a chance that they might pass a law in 2026 that pertains to the 2026 tax year, and they will make it retroactive to the start of the year. That is within their rights. Now, we hope that doesn't happen.
How do we plan for something like that?
It is a tough one. We want to lay out, to Luke's point, awareness. Have a sense of where the pitfalls might be and have great conversations with your CPA, with your financial advisor to ensure that you're at least aware of if there's a clear win in front of you, something you can maybe execute on right now that's going to put you in a better position for 2026. Or maybe there's some options where it's maybe 6 of one, half dozen the other about how it happens. And maybe they'll give you enough heads up that you'll know what to do. And if they don't, at least you're aware of the risk you may or may not be taking with a choice. So I just want to throw that out that this is such a big deal, but it is unfortunately not a definite deal. I know.
I love big maybe here. Well,
Big maybe.
talk to us about things that people should be aware of and what maybe would help them.
Okay.
Go ahead, Luke.
I'll take that one. If you're a small business owner, there is something called qualified business income. And right now, if you're a qualified business and go read the regulations on what that means, you can deduct 20% of your qualified business income. You can take it as a deduction. So it's essentially not being taxed, that 20%. So that was a big lift for small businesses, sole proprietors, S corporations. They all got benefit from that. That would go away potentially under a sunsetting kind of provision. Now, I did read that that was enacted to try to make things more fair between the individual business owner and the corporate income tax rate. So corporate income taxes were at 35% in 2017 before this change was made. And now they've gone back to 21%. And and there was a group of people that said, "Hey, we need this qualified business deduction because all these big corporations just got this benefit. Let's try to benefit the little guys." Now, the corporate tax rate continues. It actually does not sunset. Now, there's a lot of political argument about we should increase that or not increase that. But the fact is, it's scheduled to continue on. So there's some better chance that this qualified business income deduction continues on as well, just to keep that parity between the corporation and the small business owner.
So just to make it clear, the corporate 21% continues ad infinitum.
That's right.
Okay.
Yeah, great distinguishing general rule of thumb is when you think about TCJA is if it affects a business, it will probably continue as is based on what was passed in 2017. If it affects an individual and flows onto an individual tax return, there's a great chance it's set to sunset. So I'm not gonna agree and say that's definitive to then mark across
Right.
the board, but that's a good rule of thumb to keep in mind. So we are really talking about things that are going to impact individuals and individual families. Something we forgot to mention earlier, but is also a really big, very impactful change that could be coming up is the sunsetting of the current estate exemption limits. So a lot of people aren't familiar with the estate tax. To have dealt with the estate tax over the past 6 years, you would have had to have a taxable estate at an individual level. So one person of over about 13 million right now. So a lot of people aren't impacted by this. They don't pay any estate tax, which is great. But it is set to sunset. It'll pretty much get chopped roughly in half, probably somewhere around 6.8 to $7 million will be the new exemption limit. And while that is still a large number, and that would be a perfectly lovely estate to pass with still in your possession, there's going to be a lot more people impacted by that. And so we are trying to make our clients aware, and we want more widely people to be aware that there might be some planning opportunities to be made if you're approaching that mark or are on track for that mark, or if you've already exceeded it and you are somewhere in between the $6 and $13 million of total estate. So that would include everything from portfolio income to the value of your house to anything that you can say is an asset in your name. It's a worthwhile conversation to say, is there anything I should do now to make sure that pretty much I'm not going to have a lot of my estate taxed at 40% upon my death? And there's a lot of options out there, but we really want people to be aware and go talk to both, again, their financial advisor and in this case, an estate planning attorney to see what options might be out there for them to really ensure their estate plan is taking care of business for them and for their family and upon their passing.
How much lead time do you need to make these changes?
That's a great question. And I think there's certain times that are kind of trigger times within this discussion. The first time is the presidential election and the congressional elections that's going to take place in November. That's going to be a big deal. So I encourage everybody to get out and vote for your person. But the chances of, because former President Trump passed these, he certainly would like to continue the TCJA beyond the sunset period. But he may or may not be able to do that, depending on how Congress and the Senate line up. So it becomes this really kind of quirky math equation where you can have a president that wants something, but he can't get anything done because the two other houses kind of line up against him. If the party in power has all three houses, the Senate and the Congress and the executive branch, then there's a good chance they can do whatever they want to. So in the case of a Trump reelection, you're probably going to get an extension. In the case of a Harris election, it's much more uncertain whether they would let it kind of die on the vine and sunset or try to make different laws and push a new tax code altogether through.
Yeah, and within the individual's timeline and opportunity, there's a couple things you can always be doing and keeping your eye on that you should be hopefully assessing year to year to year with the help of your advisors. Um, a couple things would be accelerating gifting. If you, for some reason, were in a place where you wanted to make some pretty large gifts, um, either do it soon, especially if you were going to do cash, because there was a higher cap pretty much on how much cash you can gift and get a deduction for with TCJA that will go away. Or it might make sense to actually hold and bunch those for later, depending on what your situation is. There's always the opportunity to do a Roth conversion, which means taking some of your income that might currently be living in a 401k or a traditional IRA and converting it over to a Roth account, Roth IRA. You are going to be taxed in the year that you complete that conversion, but you'll be taxed at the lower rates that we're currently at and not at the higher rates in the future. For comparison's sake, we ran a really basic tax projection based on a married filing joint household earning $150,000 of W-2 income. No other complexities. We didn't throw in capital gains or portfolio income because those would always throw the picture a little bit. And it's important, I think, to note that in 2024, that would yield somewhere under $17,000 of federal tax, $16,682 to be precise. And if we just forward to 2026 and assume that everything sunsets and we're taxed at these higher tax rates, it's about $3,300 of extra tax. You'll be paying much closer, just under $20,000 of federal tax. That's not anything other than just your straight federal ordinary income tax. I think if nothing else, if anyone hearing this took nothing else away, I would just say be aware to know what your current withholding is on your pay stub. Have a sense on if you pay extensions, maybe bump it once we hit 2026. If we haven't gotten an answer by 2026, put a little extra cash in the savings account so when we actually have tax filing time, you're not going, dang it, where's the money? Where am I going to pay for this? So if nothing else, I just want people to be aware that this shift is potentially upon us and you can plan a little further ahead.
How about those pesky receipts? I hate keeping receipts.
You're going to keep more of them. Going to keep more of them if this goes back to the old way. But it really comes down to the individual situation. Tax is so complicated. You can know a tax rate is going up, and you can know that that person is going to be subjected to that tax rate. And through the magic of the complexity of the tax law, that person may end up paying less tax based on some other deductions or personal exemptions that now come into play that they didn't used to get the benefit from. Prior to 2017, we had personal exemptions. Now we don't have personal exemptions. Those will be coming back. Those only affect some people, but not all people. So it's a quirky thing that you just can't look through and say, I know this change. Is it good or bad for everybody? It's really individual. So we have the benefit of having some really good software that essentially, knows all the ways that things are connected and, how this affects that. And we can tell you if it's going to hurt and by how much. So, the election matters. You've got 2025 to kind of think about it, what you're going to do. Very proactive people may want to, if going back to Megan's example of a Roth conversion, you're accelerating income, you're bringing in income before you really need to. Maybe you want to break that into 2 years. And if you're really kind of ahead of the game, maybe you want to, let's say you're going to do $100,000 of accelerated income to try to take advantage of the tax that we know right now. And you would maybe pull 50,000 into 2024 and then 50,000 in 2025. And maybe that results in a lower tax hit because you divided the income over 2 years versus one. So unfortunately, a whole lot of maybes.
I will say behaviorally, it's probably not a bad idea for people who either, whether they're working with an advisor currently or are not, is to the point of your receipts, maybe take stock of what could qualify as an exemption or as a deduction for you in the future. There's going to be a lot of people, and I'm going to point to myself just age wise. I didn't have kids before, we had the TCJA passed. I didn't think about child tax credits, personal exemptions. I didn't have deductions for childcare. I have all of those things now. And I'm not accustomed to thinking through my financial plan through that lens. And there's going to be a lot of people who made a seasonal shift in life where all of a sudden they might need to say, I actually do give a lot to charity. I should take stock of that. And do I cross a threshold? And what if I also added in, a couple other itemized deductions? There's a chance you're closer than you think. The new deduction, for example, is going to be about $16,000. So halved, but a notable number. And yet there are still people out there that they might be close based on their personal situation. So I think it's one of those financial things where it just helps to be aware. I think taking some personal responsibility to look through your own situation. Obviously, if you have an advisor, they will be looking for this for you and asking you the questions. We always are asking our clients these questions, but take stock and just say, maybe this will work out better than I think. If it doesn't work out as well as I think, am I prepared to pay the tax bill? Because nothing is worse than coming to filing time and saying, oh no, I owe 3 times what I thought I was going to owe. I didn't like that at all. So that's what we mostly want to avoid.
If you were to make these changes in anticipation of the law sunsetting, and it doesn't sunset, it's extended, where does that put you?
Not in a
In a
bad
good
spot.
situation?
Not in a bad spot.
Okay.
So the give up, the penalty for making a wrong decision in that case is not too bad because you would have paid the tax sooner, but you would have paid at the same rate as if you would have paid it later, assuming extended the TCJA gets extended. So the top tax rate right now is 37%. That would be scheduled to go back to 39% if the TCJA does not get extended. So if you pulled income forward, you'd pay at 37%. And if they don't change anything and TCJA actually gets extended, you're going to pay at 37%. So you just advanced it ahead of time. So there's probably a little loss, but uh, it's not super meaningful.
And depending on what you've done, for example, a Roth conversion, let's say you did it this year and you pulled the trigger on that 100,000 all at once, to Luke's point, that would probably bump you in a tax bracket, to be fair. But let's say you pulled that forward, they don't extend. Well, the good news is you now have a bigger Roth, which grows tax deferred for the duration of the future. And we're relatively assured, just due to change, that tax rates will change again in the future. I don't know what direction, I don't know how, but I know that we are unlikely for me to see the rest of my life at exactly the tax rate and schedule that we currently have. So, not a bad thing to behaviorally pull a trigger on some things that might be wise regardless. You're probably not going to be ruined by that or anything like that. Might be a couple dollars give up, but might be a really good risk to take or a good chance to take just to, again, offset the potential downside in 26.
You've touched on so many things here, and more and more questions pop up. But before we get into stuff, is there something that you really think we should answer here, or is there a point that we haven't touched on you want to make sure we do?
Yeah, I don't think so. I think we touched on a lot of important stuff. I think it's awareness right now and the call to maybe action. So the call to maybe action happens after we know the results of the November elections. We'll have we still won't know everything, but we'll have a better idea of the trend of where things are likely to go. And you got a little bit of time then. You've got a little bit of 2024 left. You got all of 2025 left under the old rules. So I think building awareness with the thought that we maybe need to do something later this year or early next year.
All right, maybe action. Megan, you had something else?
Well, the only other thing I was going to say is if you're somebody who's been pretty confident the past 6 years managing your taxes on your own, doing it with TurboTax, that may still be perfectly appropriate. But if you happen to have an increased complexity in your tax situation over the past 6 years that was kind of reduced due to some of these changes, this might be the moment to also go find a really great tax professional to give you some assistance. I know that I used to prepare my own taxes, and nothing was better than the day I gave that up and said, no, you please do that for me. It just made it, more peace of mind.
Well,
And again, with these changes being so complex, that might be a wise moment to pull the trigger on something like that.
all right. Well, how can folks reach you folks at Foster and Motley if they want to talk about these maybe actions?
I think the best way is to look on our website. It's fosterandmotley.com, fosterandmotley.com. See if you see anything that you find interesting and give us a call if you do. We're always happy to talk confidentially, and we look forward to helping more people.
Well, whether or not the tax code changes at the end of 2025, it never hurts to review your situation and plan ahead. And the team at Foster and Motley is here to help you. Whether you're planning for new tax changes, updating your retirement plan, or need any other financial planning support, follow the Foster and Motley podcast to stay up to date on important topics affecting your personal finances. Thanks for being with us.